You know, the VIX, the implied volatility index, well, it's telling us something quite clear right now, and I'll show you this in just a minute, but it's also kind of contradicting with another indicator that is actually really telling right now. So I think we just go right to the charts. Let me flip this around and do this. So let's first look at our VIX. This is a very simple, volatility index of the S&P 500, and what you can see is that right now there's really no major fear, so to speak. You can see the VIX is basically near the lower end of the range that it's had all of 2018. And if the market was more concerned right now, you'd see some higher lows taking place. In other words, people buying more protection. So the VIX is important in that sense to watch for this kind of stuff, to look for divergences between price in the S&P 500 itself and price here on the VIX, or the levels in the VIX. At the same time, here's a really interesting chart that I actually think a lot of people are not paying too much attention to. On the top of the chart, we have what's known as the S&P 500, or the SPY ETF, okay? What the bottom part of the chart is something called the average true range of the past 14 days. So right now, the average true range of the past 14 trading sessions is actually less than 2 points. And you can see where that average true range, meaning the average daily movements of the S&P 500 or the SPY in terms of points, spiked, of course, as the market had a nice drawdown in January, February. We have, after peaking there, I guess in April, we've had a very steady decline in that. And we're now back at a historical sort of area, if you zoom back a little bit more, and look at this, sort of like this, you can see we're coming into really the lower end of these ranging. Now, it doesn't mean that we can't go lower. It doesn't mean that we can't stay down here for a long time, but you can see that we're coming back into a period. At the same time, the S&P 500 has had a very low volatility, for lack of a better term, squeeze to the upside. So again, none of this means that the market has to roll over right now. In fact, what it is doing is actually kind of confirming what the VIX is saying. And I know I said before in the introduction that this is contradicting what the VIX is saying, but the reason I was saying that is because I think a lot of people see these things as contradictory, and I actually think it's the same thing. So to make a long story short, what I would say at this point is watch the VIX. I look at so many stocks and so many sectors every single day for our clients, and right now, even though there are signs of concern in parts of tech, banks are kind of all over the place, I think the VIX right now should give us clarity that for right now, and this can change as early as tomorrow, or even today for that matter, as long as the VIX doesn't make higher lows, it is difficult right now to be short the stock market. Okay, it doesn't mean that you can't be short parts of the market or become more cautious, which I think is a good thing to do, but I don't think it's something that give us major warning signs until we start to see smarter money people come in and start buying some more put protection by way of the VIX. Hope this is helpful, folks. See you guys tomorrow.